Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Taoping.
And if you find our talks useful, please consider subscribe, like, and comment underneath. So I want you to imagine a company growing its revenue by like 79% for 3 straight years.
I mean, by any standard on Wall Street, that's a rocket ship.
Yeah, exactly. You have momentum, you have market share, everyone is cheering you on. But then imagine the people flying that rocket ship they just willingly cut the engines.
Right, they just sit there and watch their revenue drop.
Yeah, they intentionally widen their own financial losses and basically steer the whole operation straight into a storm of red ink. And, on paper, that sounds like an absolute disaster, right?
Oh, totally. Because we're all conditioned to want that clean, predictable staircase of quarter-over-quarter growth. But real structural innovation, it rarely looks like a staircase.
No, it really doesn't.
It usually looks like a construction zone.
And today, we're handing you a hard hat and taking you right into the middle of one of those construction zones. We're unpacking the anatomy of a massive corporate pivot using Taoping as our case study.
It's honestly the perfect lens to examine how deep foundational innovation actually plays out on a balance sheet before the rest of the market catches on.
Right. So our mission today, looking at their financial analyses, the technical context, and the market sentiment, is to answer a critical question for you. When a company voluntarily steps backward in short-term profits to invest in an AI-driven future.
How do you tell the difference between a brilliant strategic moat and just a dangerous financial gamble?
Exactly. Because the line between visionary leadership and value destruction is incredibly thin during these transitions.
Very thin.
So to set the stage, we have to look at this glaring tension. As I mentioned, Taoping had this massive 79% 3-year revenue compound annual growth rate. But then 2024 hits, and the narrative just breaks.
The revenue dips, the losses expand.
Right. And if you stop the clock at the end of 2024, it looks like the growth story is totally dead. But then early 2025 rolls around, and they suddenly drop an earnings report showing explosive double-digit contract momentum. So let's unpack this.
We really have to look at this as a tale of 2 very different years. To understand where Taoping is actually going, you first have to embrace the messiness of their 2024 transition phase.
It was definitely messy.
Yeah, if you just look at a single snapshot in time, you miss the entire underlying mechanism of what they were actually building.
So let's dissect the specific numbers, that messiness, so you know exactly what we're dealing with. In 2024, their revenue slipped to $36.7 million. That's down from $38.6 million in 2023. At the same time, their net losses expanded to $1.8 million. If you're an algorithm just skimming headlines for negative growth markers, I mean, that's an immediate sell signal.
Oh, on the surface, absolutely. A dip in top-line revenue combined with widening bottom-line losses is the classic recipe for investor panic. But this is where we have to separate the what from the why. The what is the loss. The why is that they were completely retooling their core business engine mid-flight.
Yeah, they knowingly sacrificed their short-term gross profit margins, which dropped from 22.9% down to 21.2%.
Which is significant.
It is. I mean, a drop of 1.7% might not sound catastrophic to a layperson, but when you're dealing with tens of millions in revenue, that represents a massive chunk of capital.
Yeah.
So why did that cost of revenue increase so sharply?
Because they were aggressively diverting capital and operational resources away from their legacy products. They wanted to build a completely new generation of hardware and software.
Specifically, the AI-enhanced smart terminals.
Exactly. And building physical hardware that integrates advanced artificial intelligence is incredibly capital intensive.
Let's pause on these terminals for a second, because we really need to understand the mechanism here. These aren't just like those digital billboards you see at a bus stop that cycle through 5 pre-programmed JPEG images, right?
Not at all. That's legacy technology. What Taoping was spending all this money to build are autonomous edge computing nodes.
Edge computing, okay.
Yeah, these terminals are capable of real-time data analysis. They use integrated computer vision and AI to actually understand the environment around them.
So how does that actually work in practice? Walk us through a scenario.
Okay. Imagine a smart terminal in a busy transit hub.
Yeah.
Instead of just playing a generic ad, the terminal's onboard AI is analyzing the foot traffic in real time.
Like scanning the crowd.
Yeah. It detects that at 8:00 a.m., the demographic is primarily young professionals rushing to work. So it dynamically serves an ad for a high-end coffee brand.
Oh, wow.
But then by 2:00 p.m., if it detects the demographic has shifted to tourists or families, the AI instantly swaps the inventory to advertise local attractions or family restaurants. It optimizes the message to the exact audience standing in front of it at that exact second.
That requires a massive leap in hardware capability. You need sensors, you need localized processing power so there isn't a lag while it talks to some distant server, and obviously the proprietary software to make those instant decisions.
What's fascinating here is how incredibly fast the market validated that massive R&D spend. Often, a company pivots, builds something cutting edge, and then has to wait 3 to 5 years to educate the market on why they need it.
Right, the adoption curve.
Exactly.
Okay.
But Taoping didn't have to wait. The turnaround was almost immediate. In the first quarter of 2025, their contract revenue value jumped 24.5% year over year.
They hit 72.5 million RMB, which translates to roughly 9.9 million US dollars just in new contract revenue for Q1.
Yeah.
That tells me the market was starving for exactly the type of smart terminal they were building. The buyers were just waiting for the technology to actually work.
And that sudden surging demand completely validates the painful margin compression they endured in 2024. They absorbed the shock of research and development, and now they're holding a highly desired premium product.
Yeah.
The operational efficiencies they built into these new AI solutions are now positioning them for serious margin expansion as they scale.
So the dust has settled on the construction zone and the new factory is operational. But, it's one thing to build shiny new AI hardware, and it's another to figure out exactly where it's being deployed to justify these growing contract numbers.
Right.
And this leads us directly into a sector that I think most people completely overlook when they think of cutting-edge tech.
You're talking about the agricultural sector.
Yes. We're looking at their competitive moat, and they've taken these AI-powered smart cloud platforms, leveraging the Internet of Things, big data, autonomous drones, and they're hyper-focusing them on smart agriculture.
Which historically is an incredibly complex, data-rich environment that has been totally starved for true technological disruption.
We aren't just talking about better tractors here.
No, not at all. Here's where it gets really interesting. We usually think of AI as chatbots or coding assistants, but this is literally AI getting its hands dirty in the soil. It's digital fertilizer.
That's a great way to put it.
To put this into perspective, let's look at their specific partnership with the Mengla County Agricultural Reclamation Group. They didn't just run a small, tightly controlled lab test in a greenhouse somewhere.
No, they successfully scaled a smart agriculture project from 75 acres up to 500 acres.
And scaling agriculture is totally different from scaling an app.
I really want to emphasize how difficult that is. Scaling software is relatively easy. You just spin up more server space. But scaling in agriculture is notoriously brutal.
Right.
When you move from 75 acres to 500 acres, you are suddenly dealing with entirely different topographies, varying microclimates, massive inconsistencies in soil density.
Not to mention the weather. Exactly, the sheer unpredictable chaos of weather. Proving that their AI and drone ecosystems can handle that level of natural chaos at scale is a massive technical milestone.
Let's break down the actual mechanism of this, because I think people hear AI and they just picture ChatGPT. How is this technology actually operating out in the fields? Walk the listener through what happens on one of these 500 acres on random Tuesday.
It functions like a nervous system for the entire farm. Picture a massive grid of crops. Scattered throughout the soil are ruggedized Internet of Things sensors.
Okay.
These sensors are constantly monitoring moisture levels, nitrogen content, pH balance, temperature, and they take all that raw localized data and beam it up to Taoping's AI cloud platform in real time.
So the cloud is constantly digesting the exact chemical state of the dirt.
Yes, and it cross-references that soil data with predictive weather models and historical crop yield data. So if the AI detects a sudden drop in nutrients in one specific 10-meter patch of the farm.
It's just a tiny patch.
Right, and it knows a crucial growth phase is starting tomorrow. It doesn't just send a text to a farmer to go drive a tractor out there. It autonomously dispatches a drone.
Wait, really? The drone just handles it completely autonomously.
The AI calculates the exact chemical mixture required. The drone loads up, flies to that exact GPS coordinate, sprays only that specific 10-meter radius to correct the deficiency, and then returns to its charging station.
That is insane.
It entirely eliminates the old method of blanket spraying, where a farm would just dump thousands of gallons of fertilizer over the entire 500 acres just to be safe.
Which wastes massive amounts of money and chemicals in the process.
Exactly.
That is incredible. And that level of precision explains why the speculative catalysts surrounding this project are so wild. There is an unconfirmed but widely discussed goal of expanding this specific smart agriculture footprint in Mangla County to 3,500 acres by 2027.
If they successfully scale the ecosystem to 3,500 acres, the economic output becomes staggering.
We're talking about potentially driving 600 million RMB. That's roughly 82.5 million US dollars in annual output just from this single initiative.
And even if we keep our fate firmly on the ground with only the currently confirmed data, Taoping has an established FY26 smart agriculture sales target of $27 million. They clearly view this as their primary growth engine moving forward.
But the real genius here isn't just the revenue, right? It's the defensive wall they're building around that revenue.
Right, let's talk about that wall.
I want to look at this from the perspective of the farm's management. How does integrating this hardware and software actually create a long-term competitive moat? Because if I'm a farm owner and I buy a drone from Taoping this year, what stops me from just buying a cheaper drone from a different startup next year?
That is the crucial distinction. Taoping isn't selling a drone, they're selling an integrated ecosystem. This brings up the fundamental business concept of switching costs.
It makes me think of the smartphone market. It's like the difference between Apple and Android, but on a multi-million-dollar industrial scale.
That is the perfect analogy. If you just buy a standalone piece of hardware, switching is easy. But think about what happens when a 500-acre farm adopts Taoping's platform.
Okay.
Their soil sensors are calibrated to the network. All of their historical predictive crop data for the last 3 years is stored in Taoping's AI cloud. Their daily operational workflows are automated by it. Their staff is trained on the interface.
So if a competitor comes along offering a drone that's 10% cheaper, it literally doesn't matter.
Exactly. Because to use that cheaper drone, the farm would have to rip out their entire nervous system. They would lose years of predictive soil data, they'd have to halt operations to retrain their entire workforce, and they'd have to rebuild their automation schedules from scratch.
Wow.
The financial and operational pain of switching away from Taoping becomes prohibitively high. Once you integrate the ecosystem, you are locked in for the long haul.
Okay, so the tech is brilliant, the market application is massive, and they're building this high switching cost moat that locks in recurring revenue. But we have to look at the other side of the ledger.
Always.
Building an industrial-scale, Apple-style ecosystem for agriculture is not cheap. How is the company actually paying for all this infrastructure?
This is where we have to look under the hood at the balance sheet. And it's the exact place where most retail investors get nervous and sell prematurely.
Yeah.
Innovation requires capital, and capital usually requires debt.
Wait, hang on, because I'm looking at these specific numbers and my alarm bells are absolutely ringing. Let's look at their liquidity.
Sure.
Currently, they have $2.17 million in cash on hand. But sitting right across from that, they're carrying $10.41 million in total debt. That leaves them with a net cash position of negative $8.24 million.
And we also need to factor in their cash burn. Their free cash flow has been negative over the last 12 months, sitting at negative $2.94 million.
Right. And if we break that burn down, that's negative $1.33 million in operating cash flow and negative $1.61 million in capital expenditures.
Right.
So I just have to stop right here. A negative net cash position of over $8 million while burning nearly $3 million a year. Doesn't that $10.41 million debt pose a fatal liquidity risk? Like, if that massive Q1 contract jump turns out to just be a temporary blip and growth stalls, aren't they basically bankrupt?
This raises an important question, and you are highlighting the absolute core of the bear case against this company. If the AI adoption stalls, that $10 million debt load transforms from an engine into a suffocating anchor. It is a real risk.
So why isn't this an immediate screaming red flag for the analysts covering them? Why isn't the market pricing in an imminent collapse?
Because professional analysts look at the structural health of the debt, not just the raw dollar amount. You have to look at two specific ratios to understand their actual survival runway.
Yeah.
First, let's look at the debt-to-equity ratio, which currently sits at a very manageable 0.72.
Meaning they have 72 cents of debt for every dollar of equity.
Correct. It means they haven't recklessly over-leveraged the company relative to the actual value shareholders hold. They aren't drowning in debt compared to their total asset base. It's a controlled leverage.
Okay, 0.72 is reasonable structural leverage. But equity doesn't pay the electric bill next month. What about their immediate ability to survive the transition?
That brings us to the second and arguably most crucial metric for a transitioning company, the current ratio. Taoping has a current ratio of 2.38.
Can you break down exactly how that works, practically speaking, for someone looking at their balance sheet?
Put simply, the current ratio measures a company's ability to pay off all its short-term liabilities with its short-term liquid assets. So
Wow.
for every $1 of bills, debt payments, or obligations that Taoping has to pay within the next 12 months, they have $2.38 in liquid assets available to cover it.
Ah, okay. So they have more than double the cash or easily convertible assets needed to survive the next year.
Yes. That 2.38 is a very strong indicator of short-term stability. It acts as a vital financial buffer. It means they aren't going to default tomorrow just because they're waiting on a client invoice to clear.
That context changes the picture entirely. They have the breathing room to actually execute this transition.
Furthermore, we need to analyze why the free cash flow is negative. There's bad cash burn, like masking poor operational performance with desperate stock buybacks or paying out massive executive bonuses while the company bleeds.
Sure.
But Taoping's negative cash flow is driven entirely by reinvestment.
You're pointing to that 1.61 million in capital expenditures.
Exactly. They are aggressively spending money to manufacture the smart terminals, to deploy their agricultural IoT sensors, and to expand their drone fleet. They are spending money to dig the moat deeper,
Yeah.
and because they have that strong current ratio providing a buffer, they can fund this massive expansion without having to run back to the public markets to issue millions of new shares, which would severely dilute the value of the stock for their current investors.
So the debt is a calculated tool. It's structured in a way that fuels the growth engine rather than sinking the ship. But as we know, a company's balance sheet doesn't exist in a vacuum. It's deeply affected by the world around it. We have to look at the macro playground.
We do.
How is the broader global and economic environment acting as a tailwind for Taoping right now?
The macroeconomic factors aligning right now are incredibly potent for a company positioned exactly where Taoping is. There are three massive external forces at play here.
Let's run through them. Force number one is the obvious one, the massive global sector rotation into artificial intelligence. We have seen trillions of dollars sloshing around the markets looking for a home.
Absolutely.
But investors are getting tired of funding theoretical AI models that don't generate cash. They're looking for companies that have actual deployable, revenue-generating AI use cases.
And Taoping, stepping out of 2024 with a fully realized 500-acre smart agriculture deployment and a 24.5% jump in Q1 AI contracts, offers exactly that. It's a tangible, physical application of AI that is already proving its economic value.
Force number two is the broader economic environment regarding interest rates. We're looking at a landscape with significant potential for rate cuts on the horizon from central banks.
Which fundamentally changes the math on that 10.41 million debt we were just worrying about.
Oh, true.
If interest rates drop, the cost of servicing that debt becomes significantly cheaper. Their monthly interest payments go down, which instantly improves their cash flow situation and frees up more capital for R&D. And that happens all without them having to sell a single extra drone. It is a massive passive tailwind.
And finally, force number three, the geopolitical landscape, specifically international trade policies and the reality of global tariffs. And to be clear, we are looking at this strictly through the lens of pure economic causality.
Right, strictly economics.
Yeah.
The reality of a fractured global trade environment has traumatized global supply chains.
If we connect this to the bigger picture, that trauma has created a powerful defensive economic reaction. Municipalities and large agricultural conglomerates in China do not want their critical food supply infrastructure reliant on foreign software or hardware.
Because it could be restricted by a sudden trade dispute.
Exactly. They are actively seeking fully localized domestic technological solutions to ensure their data ecosystems remain secure and uninterrupted.
They want the sensors, the drones, and the cloud software entirely built and managed in their own backyard. It's a push for technological sovereignty.
Precisely. And Taoping has positioned itself perfectly to capture that surging localized tech demand. Because they offer a fully integrated domestic tech moat, they are highly valued right now as a source of stability in an unpredictable global market.
Which brings us to the actual investment thesis for the stock right now. Based on the analyst summaries, Taoping currently holds a 7 out of 10 bullish score. The prevailing thought is framing this setup as a 3 to 6 month swing trade leading right into their upcoming Q2 2025 earnings report.
Because that Q2 report will be the ultimate moment of truth. Will the massive Q1 contract growth translate into sustained, recognized revenue? Or was it just a spike?
What I find truly fascinating about the market sentiment around Taoping right now is how incredibly quiet it is.
Yeah, it really is.
The quantitative sentiment scoring is totally neutral. There's no breaking negative news dragging them down, but there's also no wild insider cluster buying or institutional frenzy pushing the stock up. It's just remarkably steady. And honestly, I think that quietness might be the defining characteristic of this setup.
How so? What is the quiet telling you?
Well, it feels like the entire market is collectively holding its breath. The growth is there on paper. The agricultural contracts are signed. The AI terminals are deployed. But the broader market wants to actually see the cash clear the bank in the upcoming earnings report before they officially price in the turnaround. They want proof that the 2024 transition is truly over.
That is a very astute read on the psychology of the market. The market has already priced in the risks. The 2024 revenue dip and the $10 million debt load are already reflected in Taoping's currently low valuation.
Right.
What has absolutely not been fully priced in yet is the massive profitability reversal that will occur if that FY26 $27 million smart agriculture target actually materializes.
So to synthesize all of this for you, whether you're actively building an investment portfolio or you're simply fascinated by the mechanics of how technology reshapes the physical world, Taoping represents a textbook masterclass in corporate transition.
It really does.
They willingly endured significant, visible, short-term financial pain, widening their losses, compressing their margins in order to build a long-term, high-switching cost ecosystem.
They stepped backward into the shadows in 2024 solely so they could leap forward in 2025.
Exactly. They're taking artificial intelligence out of the theoretical realm of chatbots, and they are integrating it directly into the dirt. From dynamic advertising terminals optimizing consumer behavior in real time to autonomous drones optimizing crop yields down to the millimeter.
All while navigating a tricky, debt-heavy balance sheet by utilizing strong, short-term liquidity buffers.
And riding the massive macroeconomic tailwinds of localized tech demand and a global thirst for applied AI.
It is a brilliant strategic repositioning, provided they can continue to execute and scale these massive agricultural projects.
It really is. And as we wrap up today's talk, there is one final lingering implication of all this that stretches far beyond Taoping's balance sheet or any single earnings report.
Absolutely. When we look at the integration of AI cloud platforms into industrial agriculture, we have to consider the long-term reality of data sovereignty.
Right. Who actually owns the Earth's data?
If an AI platform controls the food supply down to the exact chemical composition of the soil, predicting crop yields with terrifying accuracy, that data becomes one of the most valuable commodities on the planet.
It's incredible to think about.
As specialized tech firms become the central nervous system for global agriculture, we have to ask, what happens to global food security when sovereign nations rely entirely on proprietary, closed-loop software to feed their populations? Are we trading the unpredictability of nature for total dependence on the algorithms of a handful of tech companies?
That is a deeply unsettling yet vital question to leave on. A huge thank you to you for joining us on this exploration today. Remember to always look past the surface-level financial numbers, understand the deeper why behind a company's transition, and keep questioning the data around you. We'll catch you next time.